Good afternoon, friends. Everybody have a good lunch? Yes? Okay. Everybody have another cup of coffee after your lunch? No? I've got two strong cups of coffee joining us on stage here in just a minute, David Lundgren and Jerry Parker, to talk about the tenets of Trendfollowing. But before we get to that, I need to make a couple of quick housekeeping reminders. I'm sure you're all on the Wi-Fi already. I have seen social media blowing up, so thank you very much. Continue with that. And I want you to pull out your apps right now, grab your phones, because I have two questions for you. And it's going to help our next presenters understand who it is that they're talking to. So, Kazad, let's pull up the first question. And what I want to find out is how many of you are completely systematic, and how many of you are completely discretionary, and how many of you fall somewhere in between. There are three questions there. It's coming soon. Somewhere in the Ethernet. So you've got option A, fully systematic. I have a self-driving portfolio. Never crashes. B, a blend of model-driven and discretionary decisions. Or C, completely discretionary. My hands are always on the controls at all times. Where do you fall? There's no wrong answer, don't worry. But people can see what you're typing into your phone. Okay? Excellent. Jerry and Dave see that too. Let's close that poll, Kazad. Let's look at the next one. And here I want to understand how many of you are momentum-driven trend followers, and how many of you would describe yourselves as value investors or focused on mean reversion. Technical analysis can be used in both directions. I'm not going to argue on that. Type in your answers right now. Fully value-driven, value-oriented, capitalizing on mean reversion. You fade the trade. Growth at a reasonable price, somewhere in the middle. Or a momentum-driven trend follower. You guys are in good company. I see a lot of folks typing in C. Excellent. Thank you, Kazad. Let's pull back to those announcements. Because after this session, you will have one more interactive session block where you'll choose from 4 different topics. And before we get to that, I want your help in thanking our sponsors once again. That lunch that we all loved, all that coffee that we've been drinking, would not be possible without these wonderful supporters. So to Optima, Money.net, Stock Charts, All-Star Charts, UWorld, Wiley Efficient Learning, William O'Neill and Company, and of course NDR, Seasonax, Direction Funds, TC2000, and Miller Value Partners. Please give them a warm round of applause. I also have to thank Kazad on the controls, and Elena at the desk, and Barbara at the other desk, and Joel Panicott upstairs, and Alvin Kressler in the other room. There are a few of us on the CMT staff, and the countless all-nighters that these folks have pulled to pull this all together do go unnoticed because it all seems so seamless and simple, right? It all works. It only works because they work so dang hard. So please help me thank the entire staff of the CMT Association. Okay, right now, you guys are in for a treat. Everybody has heard of the Turtle Traders. You've all read those books. You understand Richard Dennis's teachings. We are blessed to have Jerry Parker, who's going to be interviewed by my dear friend, my work wife, I think is what we call each other sometimes. Fill the Gap is the official podcast of the CMT Association. It was Dave's brainchild, and he was silly enough to ask me to get involved. I don't know who makes your decisions at home, but we have had a joyous 3 seasons. And just raise your hand if you've been a guest on Fill the Gap over these last couple years. See these hands going up? JC, Paul, we got a couple. Yep, there we go. So when we're all done here with this session, we'll bring you all up on stage. I want to take a quick picture. But right now, I would like to welcome these gentlemen to the stage to talk about the tenets of trend following. Welcome to Fill the Gap, the official podcast series.
I actually hear that in my sleep. Thank you for being here. Thank you for taking the time. One thing that can absolutely be said of you is you're incredibly generous with your time. I mean, you're on podcasts all the time, sharing your your experiences with trend following and, of course, the Twitter spaces that you do, and just very openly, if not opinionatedly, share your views on trend following. And it's just incredible that you do that. So my challenge for me was to, what kind of a conversation can we have that's as meaningful as it really deserves to be in an event like this, while at the same time something that you haven't really spoken too much about. So not too long ago, LeBron James was asked, you're in the NBA, and what is it about you that allows you to literally dominate these otherwise very talented athletes? I mean, the NBA is home to the best basketball players on the planet. And when he matches up against them, sometimes it looks like it's the first time they've ever dribbled a basketball. He's just incredible. So they asked him, what is it about you? And he said, to make sure I quote this properly, but he said, the mental aspect of the game is what separates the good players from the great players. So it's mental. So the idea is that they're all equally talented. He didn't say, I'm just a naturally gifted athlete, because they all are. I show up at the gym first and I leave the gym last. They all do that, right? So it's not that. It's not the things those are things you must do, but there's something that differentiates LeBron James from everybody else that does that. And he would tell you that it's mindset. To bring this a little more closer to home, 100 years ago, Jesse Livermore was asked, what are the reasons for why traders fail? I'll paraphrase it a bit here, but he basically said that the speculators' enemies are ignorance, greed, fear, and hope. So he could have said, well, people don't know where to place their stop, or people aren't quick enough to recognize a change in regime when they shouldn't be trend following all the time. Sometimes they should be doing mean reversion. These are all important, but this is not what he said. It's mental. So folks, here we are. We have this incredible opportunity to have the modern day Jesse Livermore here with us today, perhaps the LeBron James of trend following, if you will. What do you say, Jerry? What is it that makes you different? I mean, when you think about the turtle experience, there was 20 of you in the first class, I think?
12 first year, 8 the second year.
And you were all taught, there were no favorites, right? You were all taught the same exact rules. Well, we won't get into that. Same rules, same risk management, same markets, same environment. You all kind of sat in the same office, in the same building. So it was a level playing field. Mm-hmm. And I think the message that I'm trying to make here is that these are very smart people, all given the same exact rules. And yet here we are 40 years later, and this stage has 2 people on it. And only one of them's one of the turtle traders. So why is that? What was different about you that where you were able to take those same exact rules that everybody else was taught by the master of trend following, and here you are?
Well, I mean, that's a pretty daunting question to say something as smart as Livermore and LeBron, so I'm not sure I'm up for that. But, well, I think number one is you got to have a certain passion for and fall in love with trend following. When I was my early 20s, I heard about trend following. I read about it, no internet, and I was like, oh, this is the greatest thing ever. And then my love has just increased every day since then. And I was just tremendously dedicated and passionate about trend following. I think maybe in hindsight, the Richard Dennis and the Turtles were more interested in systematic trading. And it just so happened at that particular time, it was trend following, short-term trend following. And it was later when I realized, okay, maybe I was just always a trend follower. And of course, it has to be systematic and rules-based and back-tested. But I just think, I just remember saying to myself, I'm going to preserve capital. I worked in an accounting firm, and I was like, definitely wanted to preserve capital and make money. And I thought, are the big winners going to pay for the losers? That's what it was all about. And I think just having that resonate with me at such a young age, I didn't need more education, more experience, someone choosing the exact right words. So often clients end up not liking trend following, they end up bailing on the investment, and we are always sitting around, what could we have said to these people? There was nothing that anyone needed to say to me. I loved it. I just wanted to understand it deeper and get a philosophical foundation You've got to come up with specifics, the rules, and how you're going to do things. But philosophically, what is it all about? And so even today, I kind of feel like I can get deeper and understand at a deeper level all the time exactly what's going on. It's a lot more to it than you would think.
Right.
Yeah.
Right.
And I think with, number one, coming out of the Turtle program, one of the things that I think that the Turtles were sort of taught is, clients are a problem. They're kind of a problem, and they're gonna tempt you to do wrong things. Get out of the trade too quick. Don't give back all that profit, and things like that. So coming out of there was maybe a chip on the shoulder of be careful with clients. So I think a lot of Turtles just chose to trade their own money or not have a big business, trade just for a few people. And so I think one of the most important things is that I wanted to have a big business. And so, and then obviously having a successful big business was being dedicated to a great strategy and understanding everything we had taught. We were taught not only the specifics of how to trade, but how to stay alive forever and how to evolve, but not evolve too much, but evolve enough. And I think I was never tempted to add things to the trend following or to water it down in a way that would be more palatable to myself, my personality, or to clients. I think that is very important too. It's really difficult to take small losses and let profits run. And the temptation is we can do better than that, and you really can't.
Yeah, interesting. You mentioned twice now, take small losses and let profits run. That's essentially the expectancy formula. So it's basically how often are you right times how much you make on average when you're right, how often you're wrong times how much you lose when you're wrong. Take the difference, and if it's positive, keep doing it. If it's negative, stop immediately because it doesn't work, right? So in your experience, and I think this is perhaps one of the more difficult things about trend following in particular, is part of that formula. Every strategy has to go through the gauntlet of that formula. No matter, like Warren Buffett just this year in his shareholder report, if you cover up his name and just listen to what he's saying, he sounds like he's a trend follower, because he says in his report that I've been doing this for 50 years, and it's probably a time for an accounting, like how well have I done? And he comes right out and he says my capital allocation has been at best average, and you can actually look at my long-term record, and the returns are basically the result of 10 or 12 really good decisions. So do the math, that's 1 every 5 years. Everything else has been mediocre at best, right? That's trend following. So do you think that the frequency of just being wrong all the time is something that contributes to the difficulty of properly executing what is ultimately, I would say, is one of the best strategies you can follow over the long term?
Oh, definitely, especially when you first get going. I know, okay, so one of the major rules was do the trades. You don't want to miss these outlier trades. And so the most important thing is to actually just do the trade. And so after the first week of trading, we all got a phone call from Rich, and he was like, how do you think you did this week? And I was like, I don't know. I don't think I did very well. He goes, well, how many trades did you do? I said, maybe like 10. And he said, how many do you think you should have done? I said, probably like 30. He's like, yeah, you got to do those trades. And so you can't miss these big outliers. And I think that is the most important thing. That's sort of the secret of trading is hit the outliers. And I think I've never had a trouble getting out of a losing trade necessarily, but I definitely had trouble anticipating if I did a trade, it might turn into a loss. Right. So I think you just have to get over that. And but really, at some point in time, after you've done it for so long, it's not that difficult, but it's always difficult for everyone to hang on to the big winners. You get really afraid that, and Rich would say, when you have a loss, you should be afraid. It's going to get bigger, not hopeful that it's going to come back. And when you have a big profit, you should be hopeful that it's going to keep going and not afraid that it's going to get smaller. So there was a lot of little encouraging words like that over the years. But yeah, there's nothing more difficult than hanging on to those big trends. 5 or 10% of your trades are going to make all the money. And because the stop needs to be far away, the trailing stop needs to be far away so it can turn into a big profit.
Right.
But then if it's far away, every day you look at it and you're like, I could just give back a lot of this hard work or sitting with this trade. So, we have a lot of those on now, Sugar, OJ,
Yeah.
So, it is a psychological game, and there was a lot of emphasis on doing the hard thing, doing the right thing, being bold with profits and cowardly with losses.
You mentioned Richard Dennis told you that how to think about losses and how to think about profits properly, to properly make sure that your expectations that you're building within yourself are aligned with the strategy, so that when X happens, you're not surprised by it. So I just once again want to stress that notion of the importance of, I would say anybody can trend follow if it's all about just following the rules, but not everyone can follow the rules. So maybe when you can go back to the early part of the experiment, when the turtles were first founded. I'm assuming there must have been, as you were learning and just trying to figure this whole thing out, there must have been periods that were difficult, where you had drawdowns that you're really questioning yourself, and it's the mental part of the game, right? It's the same rules, and the outcome is negative because all strategies underperform and don't do well in short periods of time. What foundation did you stand on in that moment to give yourself the mental fortitude to make it through? And what was your conversation like with Richard Dennis in the moment? Was he supportive? Was he, this close to firing you? And when you look at all of that, like how did that experience prepare you for what you are today?
Well, they were always supportive. It was a pretend environment where you got the rules.
Pretend environment?
Pretend in a sense that it was going to be nothing but positive feedback. You're losing money, we don't care.
That is pretend.
Yeah. Just do the right thing. One of the things was if you follow the rules and lose money, no problem.
Yeah.
But if you don't follow the rules and make money, you may be in trouble. So after the first 3 or 4 months of trading, we were all losing lots of money. And they said, write one sentence of whether we should leave everything the same, give you more money, or take all the money away. And of course, they gave everyone more money. And so that's not what clients do. Clients will never say to you, oh, you're losing money, no problem, just keep doing the right thing. No. If you say to them, hey, I could cheat on this trade and I think it might work, they'd say, cheat. Oh yeah, go ahead and get out or violate your rules. And so, so it was a lot of hammering on us all the time. The final exam question was at the Christmas party, 1983, coming up to everyone and saying, it was a verbal question. If Rich is long soybeans, but you have a breakout to the downside and you're supposed to go short, what do you do? Of course you go short. So we would always hear lots of times that Rich was, our first big trade was short sugar. It kept going from like 4 cents to 2 cents. You roll it back to 4 cents down to 2 cents. And we heard Rich was long
the stock market today.
Rich was long the whole way down. So.
Oh no.
Yeah, I think part of the reason to have the turtles was so, here we have this chunk of money with the turtles. They don't know anything about anything except what we taught them. They're dumb enough just to follow these rules. And this gives Rich freedom to have more fun and do counter trend or.
Interesting.
Yes, trades like that. So we knew our place. But to get back to, I'm trying to remember your question. I think I remembered it. But I mean, I started so slow and I had such mediocre / bad performance initially that I think it just got to a point with me where I was so bad that I was just like.
Are we listening? Legendary.
I got no choice now.
Trendfollowing.
I mean, I got nothing to do now. Everything I've tried hasn't worked. And to some degree, it's kind of a blessing. If you violate your rules, you don't do what you know to be correct, the last thing you want in the long run is for it to work out for you. So it's never worked out for me. And I just was at rock bottom. And then from there, I was just straight up because I had realized how important it was to follow the rules because nothing else I had tried had worked. And so I got that out of my system, hopefully, in the very beginning.
So in the very beginning, when the turtles were assembled, what exactly was the bet? Was the bet that you could teach trend following, or that you could teach the mindset of trend following?
Well, I don't know. They deny that there ever was a real bet, but I do think
Just go along with my question.
Yeah. But well, I don't want to get a phone call. But I think Rich definitely thought it could be teachable, more so than maybe Bill Eckhart thought it could be teachable.
Exactly. Which aspect, though? The rules or the mindset of trend following?
That's a good question. I mean, I think if I had to put it into words, it would be more like the rules. And so we learned the rules, and then we learned all of the mindset problems that you're going to have and how you should be thinking about them. But really, you can make people aware of this. But I think each individual person has to decide how they're going to handle this.
Was it at the end of the day, because obviously you've mastered the mindset aspect of the game, so not mastered it, but we never want to say that, but you're obviously well equipped to handle the ups and downs of trend following. Is there anything at this point in your trend following journey that you feel from a mindset perspective that you still have left to learn? And like, are there things that you're still like, man, I can't believe I did that again, or is that just inevitable and it's just a journey, not a destination?
I mean, I think one of the problems is being overly competitive and overly concerned with relative performance, other people. So I get kind of bummed out sometimes.
Still to this day.
Yeah, it's kind of you get a little bummed because you want to win, and you want to win by making money, and then you want to do well compared to everyone else. Over the years too, I think I got into situations where I thought I had issues with my trading, and I thought it was not that great, and I needed to improve upon it. But in hindsight, I was like, oh, I see the problem. I was just trading too large, and I got bummed out because I would lose money. And I think that's another thing to be careful of is if you're going to lose a lot of money if you trade really large. And I think people should not. I never like it when people say, well, I want to have this strategy that I can follow. Like there's no wrong answer. There's so many wrong answers. I mean, there's so many wrong things to do. It's a very narrow path to good to great trading. Don't kid yourself that you are going to twist this methodology and do something that suits your personality. Not one thing about good trading suits my personality. I don't like anything about taking small losses. Having 5% of the trades make all the money. Giving back big profits turning into losses. All of these things are the right thing to do, but they're not that fun. And you need to change your personality so you can make money and preserve your capital, or don't trade. And so I think if there's one exception to that, and that is to some degree, can't go crazy, and that is your trading leverage and your size. Some people want to make 50%. They can handle it. They can handle the ups and downs. It's not going to make them abandon at the exact wrong time and give up on their system and have to do a non-system trade to stay in the game and not go bust. Some people need to make 10% or maybe 20%. So your choice of your risk level is, okay, I'll let you have that. You can and I think it's very important. And I think sometimes I didn't realize that I was less inclined to enjoy the ups and downs than I thought. So now I'm much better at my risk budget and my risk tolerance and volatility tolerance. But it certainly was a situation where I thought, oh, I need to figure out a way not to have these drawdowns. Well, the most important way not to is just to trade smaller and trade as small as you possibly can. And that was straight out of Rich's mouth. You're as bad as you're ever going to be when you start. Trade as small as you possibly can. And but then when we got into the actual trading, of course, the people who traded the largest and risked the most had the most. Rich liked that more. So it was like on one hand, there was a lot of politics in it and trying to understand what they said and then what they really liked. And so they told us to be conservative, but they really liked the guys who were really going for it.
Right.
Yeah. So.
So do you, at the end of the day, when the turtle project is over, can we just say definitively whether or not proper mindset can be taught? I mean, you can learn it, but can you just talk to somebody about what's it like, and then have them implement a strategy with the proper mindset, or do they actually have to run that marathon to know how god awful it is? You know?
Yeah, I think it would have been a lot better for us if we would have worked for Rich for another 4 years or another 8 years, you know, and been there longer, because he had a great mindset. Nothing seemed to ruffle him and get him upset. I think maybe he struggled with being systematic, but he never kind of got uptight about trading. I watched that show Billions, and they have that.
Is that like what your life is like,
no.
by the way?
They have that a woman who is a psychiatrist on staff.
Right.
And I think that's a really good idea. I think that may be the answer.
But you have Petey. Do you all know who Petey is?
I have a pet bird who is up by my side a lot, and she takes my mind off the bad markets.
Do you think she contributes to your calmness in the market?
No.
No. I've watched so many of your videos, and you can always hear this bird in the background, and I've never seen it, but you can always hear it. So I guess it was Tuesday, or maybe it was Wednesday, we had a Zoom call, and I can hear the bird chirping away, and then all of a sudden, Petey lands on his head. And like if a bird landed on my head in the middle of a conversation, I'd have freaked out, and I would have been like, you know, he was just like, I think he's like, get on my finger.
Yeah.
Get on my shoulder.
Well,
It's like you guys are simpatico. I think you guys are like.
No, she's fun. She's fun. But I think there's things you can do to your trading that can really help cheat the feelings. And one is proper leverage, a system that you're happy with and that you've seen succeed. You've seen the back test. You've lived through it as well. And you've seen what happens when you follow and when you don't follow the rules. Mm-hmm. And but probably the most important thing I started doing a few years ago was just trying to trade as many markets as possible.
Diversify.
Yeah, diversify as much as possible. So we trade over 300, a lot of stocks and all the currencies you can think of, all the commodities all around the world, and bonds, futures, and ETFs. We sort of spread onto ETFs. So you have this huge portfolio, moderate risk budget, and every trade is so insignificant. And you don't even think about doing the next trade.
Can you put a little color around that, so that, like, because that could mean something, a lot of different things. Like Frank Texera, who I used to manage portfolios with at Wellington, you obviously know him. You know, we used to manage a portfolio with 100 names, and in the mutual fund space, that to some people was a very concentrated portfolio. And sometimes we get down to 60 names, and people would think we were crazy. And now, when I'm managing a portfolio, it's, you know, I'm trying to target 35 names. So what do you mean when you say diversify the heck out of the portfolio so everything's small? What does that mean to you?
Well, 100 stocks and 50, 60 commodities.
Wow. Okay.
50, 60, 70 currencies. And
all at once, ongoing at the same.
Long, short, applying your systems, multiple systems, multiple trend following systems. And you end up with this portfolio that is very stable, or kind of stable. It's still going to have the big trends, we're going to have some big volatility, but maybe you're losing 15 basis points per trade.
That was my question. So when you have that many names, that also means that you're risking less per trade.
So we got stung a bit, let's say, when all the bonds rallied last month, but not too bad. But if you ever have anything in your portfolio, that could be a really big problem. Big loss. It's going to be so small, and you're still applying that 5 to 10% idea that 5 or 10% of that big portfolio is going to make all the money, and you're going to have more outliers, but they're smaller.
Right.
And so I think that's one of the things that I kind of obsessed over. Like, they're up there teaching us diversify. And so we had 20-some markets, and back in the day, 20-some markets. And then over time, I just was like, okay, I don't want to over-optimize, overfit my systems, add features, add non-trend following features, to make things better, I want to keep adding markets. So I was just obsessed with adding more and more markets. And I thought, of course, we traded stock index futures, but I was like, yeah, that doesn't sound like the optimal way to handle the stocks. You're not going to get a lot of diversification from them. You're not going to, it's an average, it's going to drag, you're not going to get the outlier that you're going to get in Tesla, for instance, or something like that. And I thought, yeah, absolutely the next extension has got to be the stock market and trading enough stock, having the weighting in your portfolio of stocks to be what do stocks deserve? You know, how many stocks should you trade? How much of your portfolio should be stocks? And I think it's quite a bit because there's just so many, and you can find so much diversification there sometimes. So we tend to trade a lot of fun stocks that have a lot of big outliers, just like all the other markets.
And is it all U.S. stocks, or do you trade global?
No, it's global.
Global. So that opens up a can of worms in terms of how many names you could potentially own. And so one question would be, how do you narrow down your list of what you're going to buy? Like in the equity space, what we traditionally do is we combine trend following with momentum, because in a really strong bull market, there will be another one one day. By the way, don't worry. This 1 year sideways is not permanent. But when the market is trending, it can be very difficult to know which one to own. So the way you've answered that question is you overlay it with momentum and you just buy the best ones. So do you by the look in your face, you don't do any of that? So how do you distinguish, like in a really strong bull market, how do you know which trend to buy if you're not using something to measure what's the fastest horse?
Yeah, there's no way to know that. And so I have my perfect approach with currencies, commodities, and bond futures that I force the stocks into that approach. So whatever I do in the commodities, I'm going to do it in the stocks. So a lot of CTAs will not trade as many markets. They won't even trade all the currencies, for instance. So they'll choose some currencies and they'll trade them. And or maybe some people will trade them all, like me. And so we're kind of like sitting there because there's only 50. There's only 55 commodities, or there's only 35 bond futures. And so the work's done for you. You don't no FOMO, no anxiety. But then you say, okay, there's 1,500 equities with a lot of liquidity or whatever, or 2,000 or whatever, and they're like shocked. They're frozen. They can't move. I can't do it. I'm just going to trade what if I don't choose the right ones? So the key is to have more or less of a fixed universe. You're going to try not to change your approach too often. Don't keep switching your look back period and your systematic approach. If it's not good, yeah, you need to switch it. But overall, you don't want to be making lots of changes, because as soon as you change out of one, that's what's going to start working.
I know that story too well.
And so you want to also have sort of a fixed universe, so you, to the best you can, and trade those markets, and you'll get your fair share. You'll get in your group of markets. Over time, you'll participate in those markets when they have the big outliers. So I choose the stocks the same way I would choose the commodities and the currencies and the bonds, which is purely based on diversification. I would never do a back test and say, oh, these are the stocks that are really good trending. No. The grains didn't trend for 10 or 15 years before 2020. So you take that out of your portfolio because the back test says it's no good. Right. You can't do that. You put all these markets in the portfolio, in the stocks, and you've chosen these stocks based upon liquidity and diversification. They're different. And then you go forward, and you'll more than likely get your fair share of outlier trades. You don't have to trade everything or trade them all. No one could do that. You can't predict what's going to trend and what's going to be the best moves. But if you just keep that portfolio kind of static, the best you can, some of the stocks, they get bought out, And so we have that happen every now and then. So, but to a large degree, that's kind of the game you want to play. I'm doing the same trades. I'm using the same systems. I'm handling every trade the same way, and I'm trading the same markets. And then that's what happens.
Right. And just out of curiosity, when you know, at the end of the day, when you do look back on the types of stocks that you do traditionally find yourself owning, do they tend to have a growth bias or a value bias, or even that doesn't even? It may not be intentional, but I'm just curious if it ends up in the end it's growth.
It's probably intentional that I care so little about that I refuse to even acknowledge what that means.
You want me to explain the question?
No. I don't want to know that. I don't want to have that in my head.
Yeah.
I guess I'm a little bit outlier hunting. You know, that's a new phrase my friend came up with.
Yeah.
Hunting these outliers. So I think there may be a little bit of evidence that it's probably better to trade stocks that are smallish, not too large, not too diversified. We don't want to buy a diversified company. We don't want diversification from a stock or a market. We want to put it all together ourselves and then have diversification. So maybe a stock with one business line, one product that can hit that outlier. You get some shortages, you get some weather, you get some something happening, and then all of a sudden takes off. I own that French fry company, egg company.
JBSS?
Lamb Weston, I think,
yeah.
and then Cal-Maine is the egg company. I was so happy when I found this egg company. And I was like, oh yeah, I got to have these eggs in here because I don't have access to
It's a commodity.
Exactly. And so that's kind of fun to find companies like that have a commodity focus, something about commodities in their business. And so I'm really prone to commodity-like stocks, mining, metals. Yeah.
Okay.
And then my favorites like Twinkies and Tootsie Roll. And sometimes I'll just throw stocks in because I remember them from my childhood. Yeah.
Is that one of your rules?
Yeah. Because I think overall, one of the lessons of trend following is all the markets have the same expectation. You're throwing all these markets together. You're doing the longs and the shorts with your system, and then you have this large sample size of trades. The only way to get the necessary sample size is to assume that they're all kind of the same. And the shorts are like the longs. You never slice and dice the numbers like, well, this is what currencies did, or this is what the bonds did. It's all the same kind of thing. And you totally ignore the fact that you might be able to predict what's going to trend well. I've never really seen that happen. I'm always surprised at what trends, and that's one of the lessons of the markets is that these relationships are not stable. What has happened in the past is not a good guide for the future, but if applying this system, these entry-exit systems, they should produce profits in the future, but it'll look different than the fundamentals that happened in the past. Mm-hmm. So on one hand, we're using the past data, but we have almost no respect for the past data in the sense that, well, now we know what to expect in the future. No, you don't. Right. If you buy the 100-day breakout and you get out at the 50-day low, that's what you think might continue to work. But how it's going to work, which markets it's going to work on, no one knows.
So it's a matter of having faith and confidence in the system over time, not any given position. And maybe that's what allows you to not be attached to any particular position, and allows your mindset to just abandon a position if you get stopped out, just because it's not about that. It's about the long-term process, and the fact that continuing to do that's what enables you to hunt for those outliers.
Exactly. You got to just be dedicated and committed to following price, and you cannot predict. And I think that is what we're bombarded with a lot. I mean, we're bombarded by that in the media a lot. And we read about famous traders who are making a big stand on positions, what they think is going to occur. And then we're following these systems, and they're right. We should have gotten out, and we should have reversed. And then you're like, oh gosh, so it's this tremendous pressure from media and from yourself and your competitors that, oh, maybe I could do better by knowing when not to do not to follow my rules. And I think that's another aspect of the psychology of it is, we're just going to be given lots of opportunities to abandon. And then when you do, then it's not going to work out. And you're like, oh, yeah, I need to go back. So you want to minimize that as much as possible.
Right. I definitely, obviously, as the point I'm trying to make is the importance of mindset and the ability to embrace the process and just execute. But even if you have the most calm mind and your most resolute belief in a strategy, even if you're that person, you're not going to make money unless the strategy actually works. So it's not to say that one is more important than the other, but I do believe that the end game, what you're sitting here on the stage for the reason that you were able to put the two together. So clearly process is important. Something has to work. So maybe we can talk a little bit about your process. So it's changed a bit. You've mentioned that you've introduced equities and things like that, but you've also changed how you're measuring trend and things like that from the original Turtle program. So why did you do that? What was the catalyst? And
I think the Turtles traded very short term, and then at some point in time in the late 90s, we started getting this feel for maybe just a little too short term, and did some research and back testing, and the longer term holding periods of holding 6 months to a year, that worked great. It had always worked great. It worked great when we weren't using it.
Right.
And so that's the major change that I made. Continuing to add markets, only trend following, I came up with this one entry, one exit, stop loss, no volatility management, no correlation management. We've got some correlation management, let's say, going when we put the portfolio together. We've got the right amount of currencies, bonds, stocks, interest rates, and so that's good. Don't touch it. Don't add in these special rules like reduce this when it gets more volatile or add to this if it's less correlated. So I think introducing these other rules drags down this sample size, and because you want to make it more smooth, you want to be smart, and you want to keep your clients. And so it's really a struggle to stick with the most robust strategy that you can, because it has a lot of negative features.
It's not easy to do. Perhaps the more robust it is, the harder it is to do it.
Yeah, and I think that's probably one of the reasons it's going to last for a long time as well, because so few people will put up with the, and it's all about the open trade profit. So you're not going to sit with a open trade profit. It's a big, huge profit. You're so risk averse that you won't even sit there and let it go and follow the rules. And then when you look at the back test says, yeah, that's how you're going to make the most amount of money. And so
that's how you capture the right tail event or the outlier.
And so you're like, oh, day one, you're like, yes, I will absolutely do that. And then day two, oh God, what are people going to think if I'm the only one who gives back all that profit? One thing that trend following or maybe even systematic trading cannot do, and that is has no ability to help you with today's trades, none whatsoever. I need to not have a drawdown. I need to make as much money as I can with these trades I have on. Well, all trend following and systematic trading says is over time, over a 10, 20-year lifetime, you will come out ahead, you will make money. This is the best way to go. But we care so much about these current trades. They're the most important things in our life right now, is these trades, this performance, my relative performance, my current clients. And that's what you have to get over, is you're playing this long game and not care too much, because doing the right thing on today's trades may not look like doing the right thing.
It may not be profitable.
Yeah.
That's the hard part, right? Because you could be doing the right thing and still losing money, because it's just where the system is, where the process is.
Yeah, no one likes big profits to turn into losses. And it's all kind of funny, because I know that's one of the cliches that I heard, like when you have a big profit or some sort of profit, move your stop up to break even. Oh, you got to break even. You cannot dare to lose money. And of course, you run that in the back test. The computer says, no. Let it turn into a loss. You'll make more money. So these are the sort of ways that you can, over the years, where we've tried to come up with ideas on what would work. And we've basically just tried to say, okay, what's the most painful thing possible? letting profits turn into losses. Yeah, and you just make so much more money if you would allow that to occur.
Yeah, that's a tough one to swallow. But I mean, like you're saying basically that if you have a stock that's up 100%, you, in your mind, again, mindset, the way you process up 100%, that's not your money. Open equity is not your money. But that's because that's what gets people to say, okay, I'm not going to take a loss on this now that it's up 30%. I'm going to raise my stop to break even so that I never let an open trade turn into a loss.
I just think the best strategy is they don't look at the markets in that particular way. They just, you have the rule, you're going to follow the rule, and if it tends to happen that you get back a lot of profit, then you should embrace that as that's a characteristic of the system. I love my system. It's going to make me lots of money. Whatever characteristic it has, it's like a child. I love this child. Whatever characteristic it has, I love it because it's mine. It's my child. And this is like these systems are our little children. They have some characteristics we don't like, but we love them and we're going to celebrate them even when it doesn't feel that good. And people accuse me of take care of that profit. You need to be more hands-on. And I'm like, I take care of those profits the best possible way. The computer says leave them alone and let them do what they're going to do. And over time, if you're willing to do that and really get yourself committed to following rules, if you're going to follow something, what does following mean? You've got to follow. And you're not doing what you want to do, which is the ultimate guarantee of enjoying yourself. Right. Do what I want to do. No, we're not doing what we want to do. We're following. Yeah. And we're willing to say, as adults, we need to get adult about this, that, hey, short-term sacrifice is how we teach our children. Mm-hmm. Short-term sacrifice doesn't feel good, but this is how you're going to do it this way. This is our family. This is how we're going to proceed. We're not going to take shortcuts. We understand that sometimes we're going to look dumb, and we're not going to be doing what everybody else in the neighborhood is doing. And you need to, but overall, our way and our methodology is going to be really great. And I think it takes time and experience, and obviously there's nothing more important than not doing that and really seeing how you wish you would have done it. Right. Like I've got lots of experience of not following the rules. And it's not fun.
That's probably more painful than following the rules and losing money.
Oh, the missed opportunity, especially when you have this miraculous situation where you get hired and you get money and you get all this knowledge poured into you by some of the smartest people on the planet, and then you don't want to mess that up. And I think that's another thing that was in my head was I don't want to mess this up. And my regret is going to be far greater if all I had to do was accept that gift and do what I was taught to do versus, I could have been 10% better or a little bit less paying by adding other features to it. And so I think minimizing regret is another reason I want to follow the rules I was taught.
But it's also being crystal clear in your mind as to how you define regret. Because some people would say regret is being up 100% and then having it go to a loss. So it's all in how you, in your mind, define regret. And the way you've decided to do it is based on making sure that whatever you do, it's putting the strategy in the best place to succeed over time. And if that's true, then my regret is going to be missing right tail events because I got out too soon. That's how you define regret.
That's right. You do not want to do that. It's so much fun to hit that big home run and to watch it all happen. And I compare my performance sometimes during really bad periods, and I'm always just shocked that I didn't do a lot worse than other people. So other people are doing their thing. They're making their own mistakes. And I was totally shocked in March where we didn't lose more money. But these systems, they work pretty well. You were asking me earlier about changing. And I just remember looking at weekly charts. All of a sudden I said, I'm gonna look at some weekly charts. And I started looking at them and all these monster trends just started popping out. Mm-hmm. Trends that lasted 1 year, 2 years. Mm-hmm. And the big problem is when they did finally reverse, there was quite a bit of profit give back. But you ended up making more money by being willing to do that. So I'm often said, I want to make the most amount of money and have the biggest drawdown. I think that's a totally great trade-off, on the trade, not over on the portfolio.
Of course, yeah.
So I think staying in the trade as long as possible, not getting bounced out, but then not staying too long. That's what we're paid to figure out. That's that fine line we walk of not taking small profits, but not giving back too much. But sometimes it's inevitable. You're going to have a bit of system failure, and it's not going to be anything that you can justify to anybody else except yourself, because you're dedicated to following the rules.
Yeah, and I would think, so I just want to remind you all as well that we're going to save 10 or so minutes towards the end for questions, and so we'll obviously open it up live mic for that, but there's also, as you know, there's a function on the app where you can ask questions and you have them go into the feed, and then we'll just also address those questions as well. I just wanted to give you that reminder if you wanted to go ahead and do that. I want to just also just transition a bit back to mindset one last time, but not your mindset, the mindset of your client. And this is, I mean, it's as I said earlier, it's one thing to have a wonderful mindset, but if the strategy doesn't work, it actually doesn't matter, right? Mindset's not helpful if the strategy itself's not working. Okay, so we've put these two things together. I have a great mindset. I believe in trend following. I'm going to be able to do this forever, no matter what happens. Trend following works. Great. Put those two things together. Let's move forward. But then I would also say that even that person has another obstacle to face, and that is the mindset of the client who's investing in the fund. And I would ask you, if you were to ever do a turtle program for trend following allocators, what would you teach them?
A lot of what I've already said. Ask the managers, things like what's your sample size? How do you define it? How many parameters? How many rules do you have? You just want, in my opinion, you want to have few rules. You want to have these robust systems with very few moving parts, and then we'll have some drawdowns. Yeah, we're going to have some drawdowns. That's going to be the downside versus too fine-tuned, too overfitted to the past, too specific to how the markets have behaved historically, and then we may not make money in the future. Yeah. Well, we'll have smooth performance. It'll be smooth, no drawdowns. I'll take the money with the drawdowns, or the volatility.
Right.
The volatility in the markets. You're going to have some ups and downs. I think you want that choppiness. You want that bumpy ride. It keeps people away.
Yeah.
Yeah.
So let me approach it from another angle. And you went through this turtle program and you were taught how to trend follow, right? And presumably, it's everyone should be allocated to trend following. I'm talking about investors now, not actual trend following managers, but I'm talking about like your clients who allocate to you. And as you've gone through your ups and downs and had maybe a 3 or 4 year period where you haven't had a new equity high, but that's all just part of your long-term record that is what it is. To re-ask, if you were to have the opportunity to start a turtle program for strategy allocators who are just trying to take capital and allocate to you, like yourself and others who trend follow, but they need to know what trend following is like. What kinds of things would you teach them in this sort of turtle program for allocators so that they have the proper mindset and expectations and things like that?
Well, I think trend following works. It's a great way to protect capital and yet still make great profits. You need to trade all these markets. Stocks are not superior. They're not better markets. They're not better trenders. There's nothing special about stocks. You need to trade stocks, single stocks, not indices, currencies, commodities, interest rates. Shorts are so important. Sometimes there's nowhere to go. There's nothing out there except shorts. They're not as great. They're not as good as the longs, but they will help when the longs are not doing well. And we've seen lots of examples last year in particular. Short the bond markets, that was a great, incredible trade. So another thing I don't like about managed futures necessarily is I don't like the marketing aspect of it. I don't like this idea of allocate 5 or 10% to CTAs, take that out of your traditional portfolio and allocate 5 or 10% for crisis alpha. I don't think that's very good at all. Trend following is this amazing approach that I don't want to have any of my money managed that doesn't have a stop loss, doesn't have a trailing stop, that is predicting what's going to happen with the fundamentals. And so I think a much better approach would be sell some of your long-only stocks, put them in a trend-following fund that is trend-following those stocks. We'll have a lot fewer crises if we trend-follow the stocks. We'll get out with the trailing stop, we'll be short, and this piddly little 5 or 10% allocation to CTAs is not hardly going to matter much anyways. So the next generation of trend followers needs to really embrace taking trend following into these other markets, stocks, and making this the core allocation. And I don't know that I would do it, but if you wanted to have like a small little percent long only, maybe, whatever. I mean, that probably would help sometimes when you have a big sell-off and then it rallies right back. We've seen that happen. So you can't have trend following failure in markets like that, COVID and different V bottoms, let's say. But overall, if you're serious about preserving capital, making good money, and doing it in a real risk-adjusted way, then you've got to trend follow those equities. And that's how the CTAs can really revolutionize money management rather than just, they all know better, but the money's there, This is the game that they're playing, but trend following needs to supersede everything else. It is the perfect portfolio if you trade a lot of markets like we do.
Right, exactly. Okay, I mean, obviously I have a million more questions, but let's go ahead and open it up for, I don't know how you want to, where's Bill? Yes. Bill, do you want to take questions from the app first, or you want to go right into live questions?
Perfect. Actually, we have a question right here. To what extent do you use options when available?
I don't use options. I think to some degree people will say that trend following is kind of option replication. You try to make your trades look a little bit like options, and you don't have to pay the premium. So I think therein lies the edge probably.
Let's take a live question here.
So when we're waiting for another question, I know when you transition to equities, obviously the big difference between equity investing and futures investing is leverage. So you can only get 50% margin on individual stocks versus bonds is, I think it's 5% margin, somewhere thereabouts. So that's obviously a big difference. How have you done anything to replicate the leverage in your equity exposure, or did you just accept 50% leverage?
Well, I think, the CTAs have a tendency to use about 10 or 20% of their cash, and the rest is in treasury. So that's a huge amount of cash available for equities. And then I think IB, though, has 6-to-1.
Right.
6-to-1 leverage in equities.
Okay.
So the 2-to-1 is not a limiting factor.
Got it.
If you probably do some research, you'll find much more than that.
Okay.
Yeah.
I have another question here. What has evolved most in your TA process since the turtle days?
Oh, shockingly little. God, how sad is that? I think just long-term in nature. And yeah, I think to some degree maybe I would on one hand say that everything else, I tried to make a few little minor changes. I tried to make major changes and had to reverse those back. But we had these were genius people. And so there wasn't a lot that we needed to do. It's rock solid money management and philosophical training. And I think to some degree you could say, okay, you're the most dedicated trend follower, turtle trend follower, but then maybe they'd say, oh no, you're way too long term. That kind of kicks you out of it. But I think, yeah, the long term stuff works great. And it's, it's like I said, it has big drawdowns, but that's what makes it keep working probably. No one likes it. Everybody wants to get rid of that.
Is it always price breakouts, or do you have, because pullbacks in an uptrend is also trend following. It's just a different location within the trend itself. So is it always breakouts, or do you actually have systems for buying pullbacks within trend as well?
Oh, buying pullbacks, that was a bad thing. Oh, you never buy pullbacks. We, like I said, we would run this research and we would say, like, come up with an idea that people hate to do. And one of the things that I learned early on, because with Rich and Bill, it was a combination of like math and computers and back testing, but then they traded on the floor, like this was the 80s. And so one of the things that all these traders in Chicago hated was buying the high of the day. Like you tell your broker, buy something, you buy the high of the day. I mean, this is like the worst thing ever. Why did you buy the high of the day? So we were like, okay, let's run some research saying we want to buy the high of the day. We're going to try to buy the high of the day. Of course, you can't always do it because you buy it, it is the high, but then it keeps going. And so we figured out that we came up with these little rules that would really try to buy the high of the day, and it added like 10% to the average trade. Yeah, it made it better.
Yeah.
And this is how it works. Put yourself in situations to do things other people don't want to do. You don't want to do it. So it's the opposite of creating a system that fits my personality. No.
Yeah, that's very unorthodox. That's not too many people think about it that way. I mean, I hear this all the time, that you need to, the best thing you do is find a strategy that fits you. That'll guarantee, not guarantee, but ensure you.
Because they go on to say the best system is a system you'll actually do.
Right.
Well, true, but maybe you shouldn't be trading.
There's always that.
Yeah. We had a 100 true-false question test that 1,000 people applied in 1983, sent out a test, 100 true-false questions, and one of them was true or false, a trader should have a backup plan. And I was like, false, because I was going to be very macho,
Yeah.
Oh, no backup plan. And of course the answer is true. So you can always have a backup plan. Maybe trading's not for you. You can do it, it's easy, you can come up with the rules, but once again, the psychological part is, doing things you don't, counterintuitive to what humans like.
It's interesting. I always say that trend following is the most contrarian thing you can do. Well, trend following sounds like it's like, well, you're just lemmings chasing each other around on trend and whatnot, but in actuality, the actual application of it, because of how difficult it is to do, is one of the most contrarian things to do. Nobody wants to buy things that have already broken out. And therefore, that's why you should want to do it.
It's shocking how long you can be in a trade, and it's continuing to trend in your favor, and the news and the kind of popular fundamentals are kind of negative against the trade. One of the things that got lost in the books and in the turtle mentality, explaining what happened, was that there was a heavy dose of contrary opinion. So Rich wanted us to take the numbers and the breakouts and the money management and also add to it a little bit of contrary opinion. So if you're long soybeans and there's an article in the New York Times about long soybeans, okay, maybe that's okay. But if you get in the taxi and the taxi driver says, how about those soybeans? Maybe you want to get out of some,
Right.
Yeah. And so it was the lowest forms of news or popular opinion. And another thing was when, let's say I remember being short yen with a big profit in 1988, I think, and the fundamental report came out at 8:30 Eastern, and the yen made new lows. And then throughout the day, it finished higher. It started rallying. And so whenever you would have fundamentals that should send the market in one direction, but the price went in the other direction, that could be kind of a trigger, lighten up in your position. But that kind of all got lost when everybody wanted to be systematic,
Right.
computerized,
Interesting,
rule-based. But for Rich, that was a major deal to be contrarian.
So am I hearing you correctly that you're saying that the very original strategy wasn't necessarily fully systematic? There was some intuition based on the things. Interesting. I didn't know that.
Yeah, that's kind of been lost over the years with all the storytelling.
Yeah.
But yeah, that was a great thing. Yeah.
Any other questions? I mean, I have many more. So
I know. I think we have
Please.
time for one or two more.
How do you define trend, and is there a wrong way to define trend?
That's a good question. Yeah, because people will say the trend has changed, and the trend is up, the trend is down, the trend has changed. Everyone knows the trend has changed. And so it's better to sort of, so I'm going to maybe backtrack and change my answer, because I think as much as I love trend following, which I've already said, I'm really more of a systematic trader. The system, it has to work. You have to do that back test, do it properly, and it has to make money. And then you're like, oh, I really like how this system works, and it is kind of trend following. And then you start calling it trend following. But it really is more systematic, and it's defined by the system itself. Because I have system one, I have 4 systems. So system 1 is long, but then it gets out quicker than system 2. And system 2 stays long. And so system 1 says the trend's over. System 2 says, no, it's still going on. And sometimes 1 and 4 can have opposite positions. System 1's long, system 4 is short, the same market. So you're right, it's defined by the system. The positions are defined by the system. So kind of in shorthand, we kind of talk about trends up, trends down, but we're really following these rules, and then these systems can be, in my opinion, fairly highly correlated, because I want them all to be long when we're in a big uptrend. But yeah, each system is defining its own kind of trend. Yeah. So you may trade 5-minute bars, and you could be long 5-minute bars, but this market is in a big, huge downtrend. Yeah, so it's all the systems define that for you.
that adds to the diversification, right? If you have
Yeah.
diversifying by product, but also by entry and exit.
That's super important. We used to the Turtles traded two or three systems. We trade at least 4, 5, 6 systems, different entries, different exits, highly correlated. When you're making money,
Yeah.
hopefully, you want them all to be doing well. But then when these markets turn around, it's important to have multiple exit points. And sometimes you'll get out, the quickest system will do well because everything else gets elected later. Or no, it's as soon as you get out of system one, it goes right back to the highs. You stayed in on the other systems and you got to get back in on system one. So diversifying the P&L is I think the way you want to look at it. They're highly correlated, but the individual market P&Ls can be a lot different. Mm-hmm. Yeah. And that's worth trading.
One more?
You profoundly pointed out that clients themselves are very problematic. What advice would you give in quelling clients when they want to do the opposite of what should be done?
I mean, you really don't want them to be too good. They need to be weak, and because you're strong. So you don't want like everyone to be as good as you. And certainly the other traders are not nearly as good either. They're more like clients as well. I think it's just not. I have a bad answer for you. I think when you have your business and you're trying to, you're just going to have a small business. You've got to find like-minded people that love trend following. Like I used to say, you need to find converts. DFA, when I've heard about them, they would sell these mutual funds, and you could not buy it as a client. You had to go through a broker or something. And then the brokers all had to go to, I think, Austin, to this boot camp and be brainwashed into long only small caps. And then you had to pass the test, and then you could go back and sell it to your clients. And I thought, that's a really good idea. We need to find like-minded people who love trend following. 23-year-old Jerry, who didn't need any explanation, no education, no nothing, loved it, loved it, loved it. Only loved it more every day for the rest of my life. And there's just not that many people out there. But they're there, so you'll have a little small business, and you'll find people who agree with you, and it's really rewarding to trade money and talk about trading with people who are your clients and who like what you do and get it. But you're asking people to do something very difficult, because it's difficult. We've already talked about that. And so, of course, there's not going to be a lot of people out there who think you should take small losses, let profits run, love the currency futures like they love the stocks. Never. So you're an elite group, an elite situation, and so it's going to be small, hopefully. I mean, maybe it'll change. Hopefully it will change. Maybe more years where the benefits of trend and shorts and markets other than stocks like last year will occur, and you'll get these instant conversions because people hate losing money. And they'll all of a sudden miraculously get it. So maybe the future is brighter than I think.
Right. Jerry, thank you very much.
Thanks for having me.